Hello everyone, and welcome back to the channel. Today, we're diving deep into a topic that can genuinely change your financial future, the core principles of investing. Now, I know what you might be thinking. Investing, isn't that super complicated and risky? And yes, it can be, but it doesn't have to be. By understanding a few fundamental principles, you can build a solid foundation for growing your wealth over time. This isn't about getting rich quick. It's about smart, sustainable wealth creation. So grab a notebook, get comfortable, and let's demystify the world of investing together. First things first, let's talk about the single most powerful force in investing: compound interest. Albert Einstein supposedly called it the eighth wonder of the world, and honestly, he wasn't wrong. Here's how it works. When you invest, your money earns a return. With compounding, you then start earning a return not just on your original investment, but also on the accumulated returns. It's a snowball effect. Your money starts making money, and then that money makes even more money. Imagine you invest $1,000 with an annual return of 10%. After the first year, you have $1,100. Simple enough, but in the second year, you earn 10% on $1,100, not just the original $1,000, so you make $110, bringing your total to $1,210. It might seem small at first, but over decades, this effect is massive. The key takeaway here is time. The earlier you start investing, the more time your money has to compound and grow exponentially. It's the ultimate argument against procrastination. Even small, regular contributions can grow into a substantial sum given enough time. Now that we understand the magic of compounding, let's move on to our second principle: understanding risk and reward. Every investment carries some level of risk. The general rule is that higher potential returns come with higher risk. A safe government bond, for example, offers low returns because the risk of default is almost zero. On the other hand, a hot new tech stock could potentially skyrocket in value, but it could also crash and burn, leaving you with nothing. The goal isn't to avoid risk entirely. That's impossible if you want your money to grow. The goal is to manage it. This means understanding your own personal risk tolerance. Are you the kind of person who loses sleep over small market fluctuations? Or are you comfortable with a bit of volatility for the chance of higher gains? There's no right or wrong answer. It's personal. Knowing your risk tolerance will help you choose investments that align with your comfort level and financial goals, preventing you from making panicked decisions when the market gets a little bumpy. And trust me, it will get bumpy. This brings us perfectly to our third and perhaps most crucial principle: diversification. You've all heard the saying, don't put all your eggs in one basket. In investing, this is golden advice. Diversification is the practice of spreading your investments across various assets, industries, and geographical regions. Why is this so important? Because it's rare for all sectors of the economy to perform poorly at the same time. Think about it. If you put all your money into a single company's stock and that company goes bankrupt, you've lost everything. But if you spread that same amount of money across 20 different companies in various industries like technology, healthcare, energy, and consumer goods, the failure of one company will have a much smaller impact on your overall portfolio. When one of your investments is down, another might be up, smoothing out your overall returns and reducing volatility. You can diversify across asset classes like stocks, bonds, and real estate, and even within those classes, for example within stocks, you can invest in large cap, mid cap, and small cap companies, as well as international stocks. Diversification is your primary defense against the unpredictable nature of the market. Okay, let's recap quickly. We've covered the power of starting early with compound interest, the importance of understanding the trade-off between risk and reward, and the protective power of diversification. Now, let's talk about principle number 4, investing for the long term. The stock market is not a casino. Trying to time the market, that is, buying at the absolute bottom and selling at the absolute top, is a fool's errand. Even professional fund managers with teams of analysts struggle to do this consistently. Short-term market movements are often driven by news, speculation, and emotion. They are unpredictable, but over the long term, the market has historically trended upwards, driven by economic growth, innovation, and corporate earnings. By adopting a long-term mindset, you can ride out the inevitable short-term dips. When you see your portfolio value drop, it's natural to feel a sense of panic. But a long-term investor sees these dips not as a crisis, but as a potential buying opportunity, a chance to buy great assets at a discount. The mantra here is time in the market beats timing the market. Focus on your long-term goals, whether that's retirement, a house, or financial independence, and don't get sidetracked by the daily noise. Our fifth principle is all about consistency and discipline. And one of the best ways to practice this is through something called dollar cost averaging. This sounds technical, but the concept is incredibly simple. It means investing a fixed amount of money at regular intervals. Say, $200 every month, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, that same fixed amount buys more shares. What's the benefit? Over time, this strategy can lower your average cost per share. It removes emotion from the buying process. You're no longer trying to guess the perfect time to invest. You just stick to your schedule. This disciplined approach ensures that you're consistently building your portfolio and takes advantage of market downturns automatically. It's a simple, effective strategy that turns market volatility into an advantage, and it's perfect for beginners and seasoned investors alike. It automates good investing behavior, which is a massive win. Principle number 6 is something that often gets overlooked in the excitement of picking stocks. Keeping your costs low. Investment fees and expenses might seem small on paper, 1% here, 2% there, but just like compound interest works for you, fees compound against you. Over decades, these seemingly tiny fees can eat away a significant portion of your returns. Imagine two investors starting with the same amount and earning the same gross return. If one pays 2% in fees and the other pays 0.5%, the difference in their final portfolio value after 30 years will be staggering. So, how do you keep costs low? One popular way is by investing in low-cost index funds or ETFs, exchange-traded funds. These funds passively track a market index like the S&P 500 rather than having an active manager trying to beat the market. Because they don't require expensive research teams, their management fees are typically much lower. Always be aware of the expense ratios of your funds, trading commissions, and any other fees. Every dollar you save in fees is another dollar that's working and compounding for you. And finally, our 7th principle, continuous learning and regular review. The financial world is not static. It's constantly evolving. New products are introduced, regulations change, and economic conditions shift. Being a successful investor means being a lifelong learner. You don't need to become a Wall Street analyst, but you should stay informed about basic economic trends and review your own financial situation and goals periodically. Once a year, take a look at your portfolio. Is your asset allocation still in line with your risk tolerance and time horizon? As you get closer to your financial goal, like retirement, you might want to gradually shift your portfolio to be more conservative, with more bonds and fewer stocks, to protect your capital. Life events like getting married, having children, or changing careers might also necessitate a change in your investment strategy. A regular check-in ensures that your investment plan continues to serve your life goals, not the other way around. It's about being proactive, not reactive. So there you have its 7 fundamental principles of investing that can guide you on your journey to financial growth. Let's do a final run-through. 1. Harness the power of compound interest by starting early. 2. Understand your personal risk tolerance. 3. Diversify your investments to protect yourself. 4. Adopt a long-term perspective and ignore the short-term noise. 5. Be consistent and disciplined, perhaps using dollar cost averaging. 6. Keep your investment costs low. And 7. Never stop learning and review your portfolio regularly. Building wealth through investing is a marathon, not a sprint. It requires patience, discipline, and a solid understanding of these core ideas. By applying these principles, you're not just gambling, you're making a strategic plan for your financial future. Thank you so much for watching. I hope this breakdown was helpful and made the world of investing a little less intimidating. If you found value in this video, please give it a thumbs up. And do forget to subscribe and hit that notification bell so you won't miss our future content. What investing principle do you find most important? Let me know in the comments below. See you in the next video.